Cost of capital and capital budgeting. Cost of capital is a term that is frequently used in financial management of a business. It refers to the cost that a business incurs in obtaining funding for its operations. Capital budgeting, on the other hand, is the process of evaluating projects or investments to determine their feasibility and profitability. In this video, we will discuss the relationship between cost of capital and capital budgeting in financial management of a business. What is cost of capital? Cost of capital can be defined as the rate of return that a business must earn on its investment to satisfy its capital providers. It is the minimum return that investors require for providing the funds. The cost of capital comprises of the cost of debt, cost of equity and cost of preferred stock. The cost of debt is the interest rate that a business must pay on its debt. The cost of equity is the rate of return that investors demand for investing in the company's stock. The cost of preferred stock, also known as the dividend rate, is the rate of return that preferred stockholders demand for investing in the company. What is capital budgeting? Capital budgeting is the process of evaluating potential investments in order to determine the ones that are viable for the business. The process involves estimating future cash flows and comparing them to the investment required to undertake the project. The objective of capital budgeting is to maximize shareholder wealth by selecting the projects with positive net present value. Relationship between cost of capital and capital budgeting. The cost of capital is an important factor in capital budgeting. It is used as a discount rate to calculate the net present value, NPV, of each investment option. The NPV is a measure of the potential profitability of the investment. If the NPV is positive, it indicates that the investment will generate more cash inflows than outflows and is therefore a sound investment. If the NPV is negative, it suggests that the investment will not generate sufficient returns to satisfy the required rate of return and should be rejected. The cost of capital is also used to determine the hurdle rate for capital budgeting. The hurdle rate is the minimum acceptable rate of return that an investment must generate to be considered viable. It is the same as the cost of capital for the business. Projects that have an expected rate of return less than the hurdle rate are rejected as they do not create sufficient value for the business. Conclusion. In conclusion, cost of capital and capital budgeting are two important concepts in financial management. The cost of capital is the rate of return that a business must earn on its investments to satisfy its capital providers. Capital budgeting is a process that helps a business in selecting investments that create value for the shareholders. These two concepts are interdependent in that the cost of capital is used as a discount rate and hurdle rate in capital budgeting. Therefore, businesses must understand the relationship between cost of capital and capital budgeting to make sound investment decisions.